Welcome to Behind the Advice, the podcast for Australians living abroad who want to maximise their financial situation. I'm your host, Mitchell Kelsey, a financial advisor at Runway Wealth Management, and in each episode, I'll be sitting down with other experts and professionals to get their insights, stories, and expertise on key concepts for Australian expats, as well as providing my own perspective. With this being a financial podcast, there is a disclaimer, so any information that you hear in today's episode is general information only. It is not personal advice, so it does not take into account your personal situation, goals, or objectives. If you do need personal advice, feel free to reach out to us at Runway Wealth Management for personal financial advice. Welcome back to the Behind the Advice podcast. Today, we're looking back at the major market events of 2025, and more importantly, what investors can expect as we move into 2026. It's been a year full of shifting economic conditions, standout performances in some markets and challenges in others. So there's a lot to unpack. To help me make sense of it all, I'm joined by someone who brings a sharp perspective on global markets and backed by a popular demand. I've got Adam Bolton, financial advisor from Bolton Financial Services with me today. Adam, great to have you on the episode today.
Yeah, thanks, Mitch. Thanks for having me back again.
And it's great to see you're bringing the Christmas spirit as well. So looking good there, mate.
Pretty good, hey?
Looking
that time of the year.
Absolutely. Let's get into it. So I think, Adam, just as a broader question to start, how would you describe the overall feel of global markets through 2025?
Yeah, that's a great question, Mitch. We've certainly seen a fairly positive year across most markets and most sectors are certainly in the green. It's been a year of sort of mixed narratives, though. Although we've seen some very, very strong performances, particularly in the US market, there's been constant, I guess, I'll say storm clouds or questions throughout the year that seem to raise their head and from a fundamentals perspective kind of makes some sense, but then we see market conditions not necessarily match those concerns or those fundamentals. So we've seen quite a strong year across a lot of markets, particularly in the US, but in the last 5 weeks or so, we've certainly seen some softening or some lack of conviction heading into the Christmas period.
Absolutely, mate. And you're right in noticing it's been a sea of green for the most part for most share markets globally. We've had a few kind of bumps along the road throughout the year, but broadly it's been a very positive year. What kind of, looking back over the last 12 months, what's probably surprised you the most?
Yeah, I think it comes down to that. Throughout the year, we've certainly seen, as you said, some bumps in the road and a lot of narrative around fundamentals and valuations and the likes, and markets still carrying a lot of forward momentum, particularly in the US markets again. And the US markets do dictate a lot of sentiment around global markets as a whole. So we certainly see a lot of narrative out there about, US markets being fully priced or even overpriced, or, the fundamentals don't stack up. PE ratios are out of control for some companies, some sectors even potentially being in bubble territory. And yet with that narrative around, we're still seeing a lot of forward momentum in those markets and the same here. And even if we look at something like the Australian market, for example, and how we performed this year, fairly positive. Last 5 weeks has taken some heat out of that. But if we go back 5 weeks, again, narrative was the market seemed very, very frothy or very overpriced. There's been a little bit of heat coming out of that. But yet when you look back at reporting season, only a few months ago, in terms of you look at the ASX market, there was about 34% of companies actually missed or downgraded guidance or a combination of the two. So when you look at that, you're like, well, that's not amazing fundamentally, but the market kept raging through that. So, and I think a lot of that was based on sentiment from the US market that, good times were going to keep rolling.
Yeah, absolutely. And you mentioned the most recent reporting season through August, there were a lot of ASX kind of blue chip companies that really sold off based on their earnings guidance and their earnings results through that period. CSL was one that comes to mind. But broadly, I mean, it's been good to see the ASX 200 benchmark index is still in positive territory for the year. I think it was up close to 6% at the time of recording this. And then on a total return basis, so if you factor in dividends from a total return perspective, it's up about 8 or 9%. So still a very solid year for investors in the Australian share market.
Which I think is the important part about when we talk about timeline of investment and about looking at the bigger picture. I think if at the start of the year we sat with clients and said, hey, the ASX 200 is going to return close to 9% for the year, grossed up, et cetera, most clients would be really, really happy with that and would take that more years than not. So, yes, there's been a lot of bumps along the road, and there's been some recently there's been a bit of a pullback, probably not as significant as we thought it might be. But what's important for investors to understand is with the US market and the Australian market, because it follows pretty closely. The old analogy is the US sneezes, the rest of the world catches a cold. Well, the Australian market is the epitome of that. But in the US market, traditionally, intra-year, the US market will see a 15% correction in any given 12-month period, and traditionally then recovers from that pretty quickly or over time. But that's a factor that I think a lot of people who maybe only look at their return statements once a year don't realise that within that 12 months, it hasn't been a straight line progression. So, yeah, I think the result for the Australian market has been quite good this year when you factor in a whole number of factors of what's going on out there, and particularly the last couple of months where there's been a lot of economic data come out, which has been probably not so favourable or raises a few eyebrows.
Yeah, absolutely. And it'd be hard to not comment on what we saw earlier in the year. The kind of the standout for me in terms of something we weren't expecting in 2025, where the tariff announcements that came out in early April, they were just arbitrary, absurdly high, didn't really make a whole lot of sense, and we saw markets kind of really sell off in response to that tariff agenda. But then spectacularly, it was about a week later, those were put on pause for 90 days, and since then we've seen a really kind of solid upward trajectory, a positive kind of sentiment in markets since then. So it's been interesting to see how the market has performed since April in particular. It's been a very solid rally.
Yeah, and I think that lends to that whole intra-year sort of factor. And something as well I think people need to understand around that tariff discussion, and it seems easy to look at that retrospectively, but even at the time, I was communicating to clients around that, is that markets can deal with good news, markets can deal with bad news. Markets do not deal well with uncertainty. And when the US government came out with those initial tariff discussions, and it seemed like a lot of those numbers were being pulled out of thin air, and even some countries or territories that were noted on there, people are like, there's nothing there, why would you have that? Well, I think that was to circumvent some sort of satellite shipping scenario popping up to help get around the tariffs, but that's a different discussion. But the thing was, it was uncertainty, and that's where the market really, really struggled with that. And that's why we saw the move that we saw at that time, and that falls in line with that, intra-year movement or correction that we tend to see in the US market year on year. It just depends, I guess, on the depth of that and the recovery out of that. But like you said, once that was put on hold, markets seemed to, and that 90-day window was sort of put in place, and then there was exemptions brought in and different things where certain sectors and certain areas got, their tariffs watered down or whatever else. The market seemed to respond quite positively to all that, hey, there's some common sense starting to filter into this process.
Yeah, absolutely. And there were a lot of other kind of positive economic factors kind of supporting markets, particularly US share markets through 2025 as well. You had inflation kind of remaining relatively benign. You had the US Fed cutting interest rates, and the unemployment kind of situation in Australia has kind of held up quite well. The unemployment rate has kind of stayed relatively low in the United States. So that's been really supportive. If we look at kind of international markets over the last 12 months, is there a particular market that stood out to you from a positively or negatively over the last 12 months?
Yeah, that's a really good question, actually. So I think the European markets have had a fairly solid year. And the reason I point that out is I think that the European markets, in a lot of people's minds, still are tarred with the brush of both GFC and then sort of the Greek debt scenario of sort of 10 or 12 years ago, around that sort of time frame. I think there's still a lot of stigma there, particularly this side of the world, around European markets, whereas some of the European markets and some of the companies there are quite solid. And if you look at things like Switzerland, for example, Zurich's becoming a real tech hub over there. So there's a lot of good things, and there's been some solid returns there. There's absolutely some challenges in some countries like Germany and the UK, et cetera, around government policy around social matters versus economic decision-making. And there's somewhat, I don't want to say civil unrest in a traditional term, but there's certainly growing noise in those markets from the public around some of the decision making being made by governments. That does add a little bit of uncertainty to those markets. But yeah, and the other one as well has been sort of the developed Asian markets as well. So if we look at Japan, for example, had a really, really, really good year, and a lot of that's based on if we look at the NASDAQ 100 index and how that's performed in the last 12 months. Technology is here to stay. It's a part of our lives. I mean, we've got how many cameras and stuff we've got filming us today. Like, it's so ingrained in life that I think that tech space is going to continue to grow. And so then you look at, say, Japan, that is very good in terms of their manufacturing and technology and that sort of space. It's not a surprise to see that their returns have sort of mirrored fairly closely to the NASDAQ type return. So technology certainly is, an area of growth that we've seen have a really, really strong result this year.
Yeah, absolutely. And I think just speaking geographically as well, it's been interesting to watch the European share markets. Like if you look at the Euro Stocks 50, it's up in local currency terms about 17%. And I think it was probably one of the strongest performers in the first 3 months of the year. It was up marginally. It was up materially higher than most other advanced economies. I think the Ukraine-Russia situation still has an effect on the local share market there around sentiment and risk off and risk on sentiment. I think there was a lot of defense spending going on in the Eurozone in the first 3 to 6 months of the year, and that really helped their local share market. I mean, still, a 17% return over the last 12 months is solid, but it probably hasn't. Well, it's probably kept up. The US share market has kind of caught up to the Eurozone in terms of market performance this year. You mentioned kind of technology being a. Well, before we get into sectors, actually, let's touch on just emerging markets briefly. What have you kind of seen in emerging markets more recently, maybe in China or India or something, in those parts of the world?
Yeah, it's an interesting space because it's an area that I'm very cautious on, and because the emerging market space has been the up-and-comer for the last, I think I've been doing this for 13 or 14 years now, and the emerging market space has been the big up-and-coming area of opportunity almost consistently over that time, and almost always has underperformed or has performed pretty average more often than not. So there's also a lot of geopolitical risk there as well. A lot of countries where policymakers can and will make economic policy decisions fairly knee-jerk and don't necessarily make a lot of sense. And so it's hard to quantify that to investors or to clients to understand that this isn't your normal space, that you're dealing with factors there that are far more unpredictable than the Australian market, US, European, whatever. But this year, both India and China both performed very, very strongly compared to the Australian market when you compare them to the US market and the relative risk that's involved. So if we look at the S&P 500 in the US performance versus, say, we look at China and India, where you'd consider them to be riskier because of the lack of probably transparency in the market and some questions around political policy making, you would look at that and go, they've held up reasonably well. So, it's been a good year for those. Yeah,
absolutely. And China, they've still got their economic targets, their gross domestic targets of about 5%. I think they'll come in close to that as we round out the year. I think maybe 4 to 5% is kind of what most economists are expecting there. And I mean, the China, the CSI 300 index, up 19% in local currency terms this year. Looking at India, I really like India from a structural standpoint. I think they've got some really good structural tailwinds coming through. They've got a lot more political stability than they've had historically. It has kind of lagged as a share market over the last 12 months. I think a lot of the tariffs essentially have also kind of impeded on the potential profitability of Indian businesses, and we've seen a lot of international capital kind of leave the Indian stock market. And I think if you look at it in local currency terms, the Nifty 50 is the local stock market benchmark index there. It's up about 10% this year, but in local currency terms, so if we convert that to Australian dollars, because the Australian dollar has been pretty strong the last 12 months. I think it's up 8 or 9% against the rupee. That's kind of absorbed most of those returns if you're an Australian investor. So it's really interesting to kind of look at things in local currency terms, but also if you convert them to Australian dollars, that can have an impact on your investment returns as well.
Yeah, absolutely. And I think that foreign exchange risk is something that, we speak with clients about in terms of if we're looking at tailoring a international exposure, where we're using specific ETFs or managed funds or even direct holdings in overseas markets, is having that discussion around foreign exchange hedging, because of that factor that you've just identified, that we can come across where, we have a really strong performance in a year, but if the currency moves against us, that can actually then significantly impact those returns. So then when we look at the end of the year, it's like, oh, that doesn't look that great. But when you actually break it down, like you said, to, the local or domestic currency overseas versus our currency movement here, and then go, yeah, okay, we can see what's happened. So not saying that hedged or unhedged international holdings is for everyone. That's a case-by-case, an individual discussion that we have with clients, but it's certainly an important discussion because it can have that impact, both positive and negative, on our portfolios.
Absolutely. Let's turn to sectors now. We were touching on technology before, so it'd be remiss of us not to touch on the technology sector in the United States, the Magnificent Seven. I was looking at some stats more recently in terms of their position in the S&P 500 index in the United States. I think just those 7 companies make up close to 34% of the S&P 500 companies, so carrying a huge weight. And a lot of that has been driven by their performance over the last 12 months. It's been exceptional. I think even just looking at Google, so Alphabet, the parent company of Google, I think it's up close to 90% just this year to date. So some exceptional returns in the Magnificent Seven. Whether or not that will continue into 2026 is another discussion. We'll touch on that as we transition into 2026. But just touching on sectors, what have you seen over the last 12 months?
Yeah, technology space continues to run hard, like you just mentioned, and we've just already sort of alluded to. Technology space also tends to stay quite volatile too. Good news is great news. Any sort of remote negative news is the world is ending, and we do see that volatility. If we look at Meta share price or Tesla or things like that, they do, particularly Tesla. Elon sneezes and that gets punished, and they remotely, just meet expectation in results, and it runs hard. Doesn't make a lot of sense necessarily, but that's the nature of that beast since the day it was, listed. And I think when we look at technology as well, we look at the AI space, and that's been a really interesting journey this year. It sort of became the market darling probably mid-year-ish, or maybe a little bit earlier than that. Some people were early adopters of that space, and now there's a lot of narrative around of whether or not that is bubble space, and there's certainly some interesting rumours or information out there about some contracts between certain companies that may or may not be holding up their own share prices, and
it's become a little bit circular, hasn't it?
I read an article yesterday that certainly indicated that when we look at that AI space and the discussion around that bubble, and they didn't say whether there was or wasn't, it wasn't to that sort of level, but it was more talking about what does the AI space look like moving forward, and the article outlined that when you look at R&D development, CapEx, and so far results or actual feet on ground progress in that space, it certainly argued that Alphabet, Google, and Tesla are starting to distance themselves, or starting to get a bit head and shoulders above, say, NVIDIA and OpenAI and stuff like that. And it certainly didn't say that this is the same as like the .com bubble by any stretch. But it said that there's some characteristics to this that are similar to what we saw on the back end of the .com bubble, where .com bubble, we saw a lot of companies that weren't worth anything, just who were handing out stock like it was toilet paper, go to complete shit. And then the good quality actual companies that were doing stuff and actually had value to what they were doing continued to motor through that and continue to rise to where they are now. And some of those companies are still listed in their current state. This was sort of saying similar, that through this AI scenario, some companies that are dabbling in it will just get left behind, or will sort of stall a little bit in terms of their development there, because they'll probably struggle to meet the enormous capex requirements to truly maximise your potential there. And the companies like Tesla and Alphabet and I suppose, Microsoft to a degree, and those sorts of really, really big, powerful companies, they'll start to separate themselves from the herd because they can afford to put the money into the R&D and the physical technology that is needed to power these AI systems.
Yeah, absolutely. We've seen a ton of capex, as you say, which is capital expenditure. So this is businesses just kind of spending a ton of their revenue, a ton of their profits, their earnings on this space, this generative AI space. And I think we're yet to see huge, like the true kind of returns from that investment at this stage. It's still yet to be seen. More recently, we saw the quarterly earnings result from the largest company listed globally in NVIDIA Corp. He makes the chips, the graphic processing units for all the AI technology. They came out. It was long awaited. Very very much. There was a lot of anticipation for that quarterly earnings result because it came in the midst of this. Are we in a bubble? Is it the hype? And then, true to their name, that they just came out and smashed expectations again. I think top line revenue was 57 billion just for the quarter. So it's insane the numbers that business is able to generate. But yeah, that AI space has been certainly interesting to watch.
And correct me if I'm wrong, but I think even within that result announcement, there was even a bit of a sneaky comment in there about, if we remotely don't smash it out of the park, the world's ending and it's a bubble. I think there was words that maybe weren't directly to that extent, but it was strongly alluded to that, they're well aware of the narrative out there and they certainly don't agree with it.
Absolutely. And I think bringing this conversation back to the Australian market, we look at financials. Financials has done very well this year. It's pulled back more recently over the last 3 to 6 months. If you look at the share price for the Australian share market darling, which is Commonwealth Bank, I think it got up to $180, $185, I think, a share at one point. It's come back now to, I think, 150. So financials was doing very well this year. Technology was doing very well. The technology sector here in Australia, that's seen a bit of a pullback more recently, just due to, I think, a few specific stocks. You and I were touching on WiseTech at breakfast this morning. That's seen a kind of considerable pullback. Businesses like Xero, the accounting software business, has pulled back from its recent high, and then there's the Technology One, which is another kind of technology business here in Australia. So we've seen that tech sector here in Australia kind of pull back a little bit as well.
Which is interesting because when you talk about those three companies, their reasons for their pullback is not. They're in the same sector, so you could easily go, that's a sector-based reason, and you can maybe or maybe not link it to some grumblings in the US or things around the NVIDIA potential result, which turned out to be better than probably, I guess, some analysts forecast. But when you look at those individual businesses, the reasons for their pullback are all very unique to their own position. So, WiseTech is based around some investigations around the chairman and some key employees. I think key employees are, no disrespect to these guys, but probably a bit overstated. Like, I'd actually look at the three roles of these gentlemen being investigated for trading in a blackout period. I think they're all replaceable if they have to move on from them. I don't think it's like an unexpected departure of a CEO, which can be quite devastating for a business. But in terms of the business itself for WiseTech, their business conditions continue on. They're in a very strong duopolistic market, huge barriers to entry from a capital expenditure scenario. So new competition in that space is very, very difficult to see happening anytime soon. So you've got that, and then you have Xero, for example, where for their perspective, it's more about certain acquisitions and R&D or technology developments and new softwares and different things they're rolling out, and their expansion to move into the US small business sector. That's where I guess some of the more compressed results have come from them, and seen the softness in their share price. But that's on short-term business decisions or use of capital or expenditure to try and build their market share bigger picture. So if that strategy works out for them, well, that could be very lucrative for them. So you look at that and they're like, yeah, they're in the tech space, but two very, very different stories about why their share price has seen softness in the last couple of months.
Yeah, absolutely. I don't want to paint them with a broad brush in that sense, some kind of company specific.
No, but then we look
there.
at, you mentioned earlier CSL and earlier in the year, because they had a pretty ordinary result announcement in August, and we saw just about everybody in that space, in that same sector, get tarred with the same brush and took significant hits, like, Sonic Healthcare and others sort of took a lick. Now, Sonic's results weren't amazing. I actually thought the forward guidance was pretty solid, but their share price certainly reacted very much in line with the rest of the sector. And there was other companies in the same boat, and it's like, this is kind of, that sector's been tarred by the same brush because of the biggest player in that space has had a rough year. The instant assumption is, there's trouble in paradise for everyone in that sector. And I think CSL is a great company. I think overall that's not so much a big picture concern, but you can see how that sentiment can spread.
Yeah, absolutely. Changing gears now, I want to get your views on a very hot topic of 2025, and that is commodities. So we've seen the likes of the price of gold, silver kind of shoot the lights out over the last 12 months. What were kind of the major forces behind those moves in 2025? How would you kind of surmise the reason for that?
That's a really good question. There's a couple of moving parts there, and it's kind of contradictory to the traditional narrative around gold and market conditions and stuff like that. So the textbook example, I guess, is that gold is a flight to safety. And so in the past, and I say, prior to the last probably 18 months, 2 years, if markets were going into a rough patch or there was, potential storm clouds on the horizon and that were moving fairly closer, we would see, markets start to move downwards, and you'd then see a fairly close, I wouldn't say it's a positive, sorry, it's not a perfect negative correlation, but it's pretty bloody close. There you see, okay, if the market's down X percent, then gold price will be up X percent. What we've seen this year is a little bit different to that. I think there's certainly an element of wavering in sentiment and a flight to safety, but then also combined with that is the real world application of gold, silver, and other precious metals in the technology space, particularly around the development of chips and the demand for chips for AI, which is incredibly chip and technology intensive, and also just the general involvement of technology in our everyday lives, like building a car these days is far more of a computer that on wheels as opposed to it being an actual vehicle. So there's a lot of chips and a lot of things that go into that. And if we go back as far as 2020, 2021, when we had the COVID supply chain issue, we saw car manufacturers out there having massive supply chain issues because they couldn't get enough chips for powered seats or heaters in seats and stuff like that. And some were having to sell these cars normally at a fairly high price at a discount because they're like, hey, we can get this for you in 3 months instead of 9, but you're going to have the old pull forward yourself seats. You're not going to have electric seats because we can't get the chips for it. So that gives you an idea of the perceived global demand that's going to come for those precious metals, particularly gold and silver, in the manufacturing of that. On top of that, some concerns around market pricing and potential downside risk, flight to safety moves. You have those multi-factors working together that have seen the price of gold and silver go through the roof.
Yeah, absolutely. Yeah. I think silver in particular has those true industrial uses. It's used for a lot of different goods. And just for context here, just for listeners, if you haven't seen the price movements in gold, so it's about 4,000 and in US dollars, 4,200 an ounce. It's up about 60% over the last 12 months, and then for silver, it's about $57 an ounce. It's up close to 94% just over the last 12 months. I think looking at gold, I completely agree with you. There's a bit of a flock to safety there. We have seen a lot of uncertainty, particularly within governments and things like that over the last 12 months. I think what we've also seen over the last, throughout 2025 has been this debasement trade, which is essentially the concept that the value of traditional fiat currencies like the US dollar or the Australian dollar continues to weaken, mostly just due to the mismanagement of governments and continuing to print more money essentially and circulating more of that fiat currency into the into the economy, and that kind of weakens the general kind of purchasing power of these fiat currencies. Whereas something like gold is relatively finite. It has those qualities of being a protection against that inflation. Yep. And we've seen most central banks just buying up gold left, right, and center. I think particularly because of what's happening in the US, there's been a lot of concern around the strength of the US dollar. We've seen some weakness in the US dollar this year, particularly on a trade-weighted basis, not necessarily just looking at the US against the Australian dollar. Yep. So I think that's really driven a lot of the demands in gold. And I think also we see kind of silver move in favor with gold. So when you see gold doing quite well, you kind of see silver doing as well, if not better. But then usually the reverse might happen as well. If you see gold kind of pulling back, silver kind of pulls back a little bit more. So it's been a very interesting space to look at. And I think if you look at the price of these precious metals over the last 20 years, there's been periods of 5-10 years where the prices of these metals has kind of been flat on net. So we're seeing some really interesting price movements in precious metals over the last. We've seen some very interesting moves in the price of precious metals over the last 12 months. Let's move into just kind of a brief economic update. So I think inflation has been a major sticking point over the last 12 months, particularly more recently. Yes. So what have we seen in the trajectory of Australia's inflation over the last 12 months?
Yeah, it's almost a story of two halves, or I'd say 3 quarters and quarter, to be honest, because for the first 3 quarters of the year, certainly inflation data looked more under control. This also was seen in the US to a degree, and we saw interest rate cuts, which is good news for mortgage holders and household budgets and stuff like that. But then the last sort of quarter, there's been a few things that sort of raised some eyebrows around that inflationary space, and I think maybe this is probably more for the 2026 discussion as well. Of even the last few weeks, been some discussions like World Bank sort of came out and was like, hey, like the Australian government has to stop spending as much money as it is because it's going to create significant inflationary pressures, which obviously then means that's also possible to create upward pressure on interest rates. I don't think our economy is in the position right now where increasing interest rates is a good thing. That's a concern. And almost like it was almost planned. Within a week of that, then the RBA's inflation data came out, and it was about 0.3 above, or tracking 0.3 above where they had expected, which is already at the higher end of normal. So that wasn't so great. And so, we saw the first 9 months or so of the year where we saw inflation under control and a couple of interest rate cuts, good news. And then that narrative seems to have flipped in the last couple of months. And I know in the US, the last inflationary data from the US a few weeks ago, again, inflation has started to creep up in the US, and that's going to stifle the Fed Reserve's ability to cut rates, which I know Trump's not going to like that because he thinks the rates need to continue to cut. I think the problem the US faces with that, you cut interest rates, that's going to increase spending, so inflation goes up further. They've also got the factor of they're starting to see those inflows now from the tariff situation that in its own right creates its own inflationary pressures as well. So it's going to be interesting to see how they try and balance that. I don't really see where the magic pill comes from to fix that. I think there is potentially a period of difficult inflationary management measures in the US to come. And then I think Australia, with their own spending issues, and even from a state perspective, we're well aware of the debt situation that Victoria's got, and they keep spending and keep making pretty, I think, irresponsible financial decisions down there in terms of budget. Tasmania got downgraded by S&P and Moody's last week. That's a headline that I don't think a lot of people understand, so I might just sort of flesh that out a little bit if that's okay, is what people don't understand with when you see a credit downgrade from a rating agency on a country or on a state, in this case of Tasmania, is what that means is if your budget is in deficit, which Tasmania's is in a massive hole, and based on their 3-year projection out to 2028 gets a whole lot worse, you're in debt, you're borrowing money to fill that budget hole, and that means you're paying interest, or the state is paying interest on that. So that's local taxpayers' money being used to pay that debt rather than being used in schools and hospitals and stuff like that. If your state or your country has a credit downgrade by these rating agencies, that means you're paying, those entities are paying a higher interest rate on that debt. So in the case of Tasmania, that interest bill on their current black hole that they've got, and it's going to get worse, that interest rate now goes up higher. So that's more money that the state government is now funneling to pay interest bills rather than spending in the economy on what matters. And I'm not sure if Victoria's had a downgrade yet, but boy, I know they've been certainly warned that that's coming their way because of their own economic mismanagement as well. So that's concerning. And if, federal governments globally and domestic or local governments in whatever sense don't take heed to that, they're going to find that in the coming couple of years that's going to get really, really tricky on how they're going to manage and manage their budgets, and they're inevitably going to have to make cutbacks.
Yeah, I think from an economic standpoint, there's a few states here in Australia that are in some economic strife there, so that they need to clean that up heading into 2026. It's probably a good segue now to kind of look to 2026. So kind of for markets, for share markets more broadly, what are some major themes that you see maybe starting to emerge in 2026, maybe some new themes?
Yeah, I think the first quarter, maybe first half of 2026, first quarter I think is going to be very interesting. We look at the current market conditions and the pullback we've seen in the last sort of 5 weeks. Things look like the last week or so they've sort of stabilised, but that's a very small sample size. So I think heading into 2026 and heading into reporting season, I think that's going to be really, really precarious time for markets, and I'm not sure there's not some potential downside risk there. Markets still feel they're very heavily priced for perfection. Maybe not so much in the Australian market, but the US market, I feel, is very much priced for perfection. So if reporting season, or truth season as we call it, doesn't hit the mark or it doesn't deliver in that space, I think we'll see some volatility return in the first quarter of next year. And then I think the narratives around management of inflation and unemployment is going to be really, really major. Household debt situations, particularly in the US, I think are massively concerning and continue to grow. And we're seeing similar patterns emerge in Australia. Granted, our credit act here is probably a little bit stronger than the US. It's still a concern. I just feel that there's a few factors there that I think will be pivotal in the first probably quarter or half of next year that will then sort of guide us from there. So,
Yeah, I agree. Certainly some stretched stock valuations heading into the new year. And what we mean by that is essentially, the price of these shares relative to the earnings that they're expected to make are very high. And they may not necessarily meet those earnings or profit expectations heading into 2026. And I think in terms of like a new trend that might be emerging is probably the rise of inflation again, but particularly. So as you said earlier, we haven't really seen a bit of a flow through effect of the tariffs in the United States just yet. I think inflation is still around that 3% mark, which is still a little bit elevated, but still it's kind of a comfortable kind of rate at the moment. At least the Fed is the Federal Reserve in the US seems comfortable with it. A lot of the narrative at the moment over the last couple of weeks is the Fed will cut interest rates again at the final meeting of 2025. So what that looks like heading into 2026 will be really interesting. And from an Australian perspective, I think most economists now are expecting even an interest rate hike instead of an interest rate cut. There's the higher probability of that kind of heading into 2026, unless we see that inflation data start to pull back a little bit.
Yeah, I agree with you there. I had a conversation with some clients last night and said, a couple of months ago, it was considered very strong possibility of a rate cut Melbourne Cup Day, if not maybe December. That didn't happen, and then since Cup Day, we've seen that economic data come out and the inflation data and unemployment data, etc., come out, where it's like the chances of seeing a rate cut before Christmas is zero. And then looking ahead into the early part of next year, I think even just after Cup Day, the narrative seemed to be, maybe February, March, we'll see another rate cut, and then if there is another one, that'll be certainly later in 2026. So there was certainly a view that those number of rate cuts would probably be maintained far more spread out. Now, I think the conversation I had with some clients last night was when we might have looked at it before and gone, hey, there's probably a, 70% chance of a cut, 25% chance of no change and 5% of an increase. If we now look at, say, first quarter of next year and say, where's the probability, we might see that, maybe 50% chance of no change, 25% chance of a cut in the first quarter. I would probably say then 25% chance of an actual increase if inflation data continues to track as it is right now, or if it dares to increase. The issue we have with our monetary policy in Australia is we've only really got the one lever to pull to help with controlling inflation, and that is by the use of manipulation of interest rates. We don't have the foreign currency sort of steps that other countries can use to help stabilise their inflation data.
Yeah, agreed. And if we look at market expectations for markets heading into 2026, are there any particular parts of the market, either geographically or from a sector base, sector exposure that you kind of like heading into 2026 and for 2026 in general, like for the whole year?
I think for the longer term, I still like the tech space for the reasons I've talked about, and part of that does fall into that. How things ingrain in our everyday life. And as the more technology does, and as the more the big players there continue to work that out, and it becomes more an everyday factor, I think that
just brings efficiencies. Yeah.
Correct. I almost liken it to it becomes a consumer staple as opposed to being a technology or a discretionary sort of spending space. So I still like that long term. It's still going to be very volatile, so it needs to be approached with a long-term investment window, I feel. And then a couple of other spaces as well. In terms of building and construction, I think there's some potential upside there. There's going to be some headwinds there. Interest rates will certainly change that narrative. But I think there's some upside there. I think anything sort of connected to the steel industry, I don't mind the look of right now. There's a narrative out there. I certainly am not on the ground to see this myself, so don't hold me to this, but there's a narrative out there that there's still quite strong demand for steel exports or iron ore, etc., to China. The Chinese construction game at the moment is a little bit fragmented and a little bit unstable, but there's some pretty strong export deals between China and the Middle East for the exports of steel. So essentially the creation of steel or making of steel in China and then exporting that to Abu Dhabi and that sort of area where construction is going berserk. So I think there's still going to be some sustained demand there. So I think that's going to be fairly solid. Again, interest rates, foreign currency risk, other factors, geopolitical, trade, just so that all comes into play there. So there's a couple of areas that I really like. And the other one is, financials had a good year. I think that continues to run. Interest rates start to rise, or discussions around interest rate rises coming, certainly adds favour to the finance sector. I just think overall, particularly when we look at the finance and banking sector in Australia and the way that that's governed and managed and stuff, banks don't lose. Like, they don't miss you.
Yeah, absolutely. And we've seen some recent developments in that space in terms of the limits that they're putting on, that APRA, our prudential banking regulator, has put on the financial sector here in Australia. So the financials sector here in Australia in particular will be interesting to watch into 2026. And I would agree with you in terms of technology and the materials sector doing well into 2026. They're probably a little bit undervalued relative to some of the other parts of the market. We're seeing a huge demand in things like critical minerals over the last 6 months, I would say. And demand for copper as well has been quite huge recently as well. We've seen that in some in the uptick in some of the share prices of BHP, Rio Tinto, and the like as well. And I think more broadly, I really like the Australian share market. It's a little bit undervalued relative to maybe some of your more international markets, such as the United States, such as Asia. So Asia's done, if you think about Hong Kong, for example, that's had a really solid run over the last 12 months. I think the Hang Seng index is up close to 30% over the last 12 months. So whether that will continue as strongly into 2026 will be interesting to watch. But yeah, really just like the Australian share market as a whole, and then some select kind of emerging markets. We touched on India, but before, I still really like India from a structural standpoint. So I like that heading into 2026. If we think about some of the risks that we might see in 2026, we've kind of touched on a few of those already. But what, as an investor, what would you kind of want to be prepared for as we head into 2026?
Yeah, I actually think heading into 2026, there's probably more headwinds or more storm clouds on the horizon than probably heading into 2025. 2025, I think, again, it's 12 months ago, but by memory, it was more, pricing and valuations felt pretty full at the time, and investors
were apprehensive, kind of heading into 2025.
But you wondered where the headwinds were coming from, because you sort of looked and goes, I don't necessarily see major risks right now or where they're going to come from. They inevitably will, because that's how the year works. It's never a straight line. Whereas this year, I think we sit here now and we look and go, national debt, both Australia and particularly the US, is a huge concern, and at some point, the chickens come home to roost there unless there's major policy change or other things like that, which may happen. But right now, you sort of look at that and go, it's a worry. Inflation returning in the US and Australia and other markets is definitely a concern, because there's been a lot of work put in over the last couple of years on the back of the sort of post-COVID run, where inflation went berserk, and there was a lot of effort made to bring that back under control. And that control seems to have been very short-lived. Like, really, it's only been 9 or 12 months that inflation in the US and Australia has been back at around or under that benchmark number. And now we're starting to look at that again and going, that's creeping back up, and the reasons for that don't look like changing anytime soon. So I think anytime we have inflationary pressure and discussions around interest rate movements or interest rates moving north, that puts pressure on stock markets as well. That means our yields on more defensive assets in our portfolios sort of increase, so then people may want to take risk off in those scenarios. So that's one thing. And then we've still got a lot of geopolitical and other factors in play. Obviously we've got Israel versus pretty much everybody, Iran, Jordan, Gaza, etc. Then you've got, the Russia-Ukraine situation, which is still playing out and could flare tempers. Iran's got their own axe to grind in their region. And then we've still got the tariff discussions that are still ongoing to some degree with some countries, or there's still a risk that card can be played, and it certainly has, even the last few weeks, has sort of been thrown as a very loose threat from the US government, that if people aren't necessarily operating in good faith, we'll slap them with a tariff that seems to be the negotiating tool of its go-to at the moment. But again, that creates uncertainty in markets, and when we see uncertainty, we see unpredictability in market behaviours as well.
Yeah, absolutely. I think, as you've summarised there, a few headwinds. There should be some times there where we'll see some positive moves, but I think there's also going to be some times where there'll be some bumpy times, just in terms of what we're seeing at the moment, and those kind of carrying on into 2026.
So I think it ties back to the last time I was on here and we discussed timeline of investment being a very, very important discussion with our clients around their portfolio management. And heading into a year like 2026, where we have a lot of unanswered questions right now, and as I've alluded to, first quarter or first half of next year could get a little bit interesting. Now, I'm not saying it will, because my crystal ball is as good as yours, but just with those potential headwinds, it's like, well, if we've got a well-diversified portfolio with a long-term investment goal in mind, we've got our portfolio built and with a risk tolerance in mind that we can navigate those waters for a 6 or 12-month period with some confidence, because we're looking bigger picture. We're looking 5, 10, 15, 20 years down the path, where a 3 or 6 month period, it may not be great news, and you may not want to look at your portfolio or look at the news.com or whatever, but if set up correctly with the right conversations at the start and in our ongoing reviews, continuing those conversations, then we can navigate those sorts of conditions with some confidence for the big picture.
Yeah, definitely. And if we think about some of the behaviors that really instill good investment outcomes, and certainly things that we emphasize and advocate for our clients are time in the market, not trying to time the market in that sense. We love as market commentators, and we love watching the markets and seeing how they move in the short term. What's ultimately really important is how these trends are kind of playing out over the long term. And ultimately what we see over time is long-term investing wins out. Ultimately over time, businesses are profitable, economies do expand, and this is all good for investors that own shares in businesses over the long term. And I think diversification is ultimately key as well. So obviously we don't want all of our eggs in one basket. As the saying goes, we want exposure to different markets, different geographies, different sectors in the market as well. But then from an asset class standpoint as well, we don't want to just be 100% in shares. We want some exposure to real estate, infrastructure, bonds. We touched on commodities earlier in the podcast. Gold, silver, some exposure to precious metals and the like, and that's kind of just setting yourself up for success over the long term.
Yeah, I agree with you completely there. The importance of diversification is. I mean, it's a fundamental to what we do and the discussions we have with clients. But I think the reason for that is evident in times of uncertainty or volatility in the market is where that becomes really, really important. And there might be people might have certain preferences to certain asset classes or sectors, and that's okay if you do, and okay with wanting to be overweight in those spaces if it's appropriate for you. And again, that's a key word, if it's appropriate. But also have to be fully understanding that each sector and each market has its own risks that are maybe separate to the overall market. So like we've already talked about, technology space has its own risks in addition to our normal market risks versus, say, the general, S&P 500, for example, or the ASX 200 or whatever else. And it's about making sure that we are comfortable with that on a day-to-day or month-to-month basis with the long-term involved before making any sort of decisions to potentially go overweight just because it sounds like something you've read and it sounds like a good idea. Is having an understanding and having a comfort level with that. And like you said, not dismissing the need for diversification in a number of different asset classes for the long term, because inevitably every asset class is going to have its challenges on the journey.
I would completely agree. And I think that's kind of a mistake that some investors make. They try and chase what's been performing well recently. There's a lot of recency bias right now. Like if you're going 100% in NVIDIA right now, I mean, that's your prerogative if you have full conviction in that. But just because it's performed well more recently does not necessarily mean it's going to perform as well or as it has previously into the future. So I would just kind of make that point as well.
And you're right about that around recency bias is a big thing in life in general, but particularly in investing. And I think if you look at like industry super funds, for example, and their TV ads, and they'll certainly bang on about their 1 year, 5 year, 10 year since inception, every June with a year that's a negative, an odd number, we perform X number, like whatever fantastic numbers that they've put together, make the spreadsheet say what they want it to say. But the disclaimer at the bottom is usually pretty clear about, past performance is not an indication of future returns, etc. And that is so true in any sort of investment. It's like, just because something's done well in the last 12 months or 2 years or whatever, to use an example, and I don't know the years exactly, but if we go back to, I think it was during the sort of late 90s or late, maybe even to early 2000s, Kodak was one of the market darlings in Japan. And so if you use recency bias there, you potentially around that time pour a heap of cash into that, only then for them to go, we don't think digital cameras are a real thing. We don't think that's going to take off. We're going to stick to our bread and butter. And, well, we saw how that played out. So, and we've seen that with other things as well, BlackBerry and with Nokia and stuff like that, where the adoption of technology or changing market and consumer needs have sort of been overlooked. And, again, you've had a company that's done very, very well historically not keep up with market conditions and consumer requirements or whatnot. And then, if you follow that recency bias, that cliff can come real fast. Absolutely.
And it's just showcasing how trends can change over time, but they can also change pretty quickly. So we want to have that exposure to other parts of the market that might benefit from those changing in trends as well. That might be a really good place to kind of end it. Adam, I really appreciate your time and your insights today. So thanks so much for jumping on the episode.
Oh, thanks, Mitch. It's been great.
Excellent, mate. Well, we'll leave it there. Thanks so much, guys, for tuning in. And this will be the last episode for 2025, but we'll be back in 2026 with new episodes of Behind the Advice. So thanks for tuning in. Cheers. Thanks for tuning in to today's episode. If you want to learn more about Runway Wealth Management and how we help Australian expats, feel free to jump onto our website, runwaywealth.com, and we're also on all the social media platforms.